O God of creation, direct our noble course, guide our leaders right, help our youth the truth to know, in love and honesty to grow, and live in just and true. Great lofty heights attained, to build a nation where peace and justice shall reign. Amen. Please, let's have a seat. I want to say a very big welcome to all of you here. I'm looking at the faces here. I know quite a few faces, and I'm excited seeing them again at this summit. A very big recognition to Mrs. Nike Akonde, Dr. Mrs. Nike Akonde, two-time former Minister of Industry, Federal Republic of Nigeria, former DG of Union Bank, and former President of the Lagos Chamber of Commerce and Industry. Can we give her a round of applause? I also see past presidents. Yes, I can see Mrs. Demerin as well. I want to say a very big welcome to you. So good to have you here again. First female chairman of GT Bank. I stand corrected. She's here. Can we give her a round of applause as well? Thank you. All right, and very many others. My president, so good to have you again. I'm sure you can't remember me, but I can remember you very well. Yes, well, who doesn't know the Chikobi family? Who doesn't know the Chikobi family? And then when you now have a Mustafa to a Chikobi, you know, you just have to know who they are. Thank you so very much. The last meeting we had was when you came to FICAN seminar. Yes, remember? We've had a few conversations after that. And when you were appointed the chairman of Fidelity Bank, I did call you. Yes, and I congratulated you. So let's give our president a warm welcome. Thank you so very much. So very much. And I also see, I stand corrected. This is Mrs. Onari Duke. Yes, ever looking. Oh, thank you for the word. I would have got into trouble. Yeah, so good to have you join us on the show, Mrs. Onari Duke. Fantastic to have you here. She's also, she is the non-executive director, Union Bank for Africa, United Bank for Africa, UBA. So good to have you joining us this beautiful day. Okay, so like, just in case you don't know why we are here, this is Bank Director Summit, annual summit. We are focusing on the conversation around safeguarding financial stability in Nigeria, new perspectives for bank directors and regulators. Key conversations we must be having right about now. Dire times we are as a nation. Dire times we are looking at our financial stability in this country. So it's important that we begin to have this conversation at this level so it can trickle down the ladder. Let me invite our president, Mr. Mustafa Chikobi. I apologize to you, sir. There's a bit of, we might need to create an, no, doesn't. Oh, fantastic, fantastic. Okay, so you'll be telling us why we are here. Is an opening remark. So can we put our hands together for our president? Is the air conditioning too cold? Do we reduce it? We're a bit, or we want to dance a little bit? Directors dance, don't we? All right, sir.
Thank you.
Thank you very much.
Thank you, David. I'm going to just ask a few questions. I must say that we had an AGM this morning, and the theme of the AGM was that we're all very disappointed that the banks don't take B-down as seriously as they should. So I'm going to ask a few questions. And one of the reasons why we picked Mr. Bode Augusto to give us a speech was that he came to the Fidelity retreat. I think it was a media retreat. And I thought that was the most scintillating discussion of the banking system I'd heard in probably anywhere. And I did a lot of work in the US. I've heard a lot of speeches. I thought that was a very, very great analysis of the banking system. And I was hoping he will come and share his wisdom with us today. Thank you for accepting. I know it was difficult. I know you had a board meeting today and you had to come early. Thank you so much. I was glad to see you here. I have a few questions. What are the threats to the banking industry today? and how can they be resolved? There are very many threats, and I'll name them. The biggest is the regulators. The regulators can determine which bank is profitable or which bank is not profitable. That should not be the case. They are too powerful. They are useful, they have a role to play, but they become way too powerful. We must address that, not because of the present regulators, not because of me, not because of any individual bank, but because of the system. We must build a sustainable system, and a system where the regulators become dictators over the institutions is not sustainable in the long run. So that's a question we should all interrogate. I'll give you, there are two things that bother me, and I'm the cause of both of them. So I have the high ground to discuss them. One is, I still don't understand why banks are paying Ancon levy and NDIC levy. In the last 10 years, there have been, I think, 8 bank failures. All those banks have been rescued, hence depositors, by Ancon. Not a penny has gone from NDIC in those rescues. So the question we must ask ourselves, again, this is not an attack on NDIC or anybody else. Please, I want to make that clear. What is the insurance that's being paid for doing? The second question, and again, I was Ancon MD, so I was a beneficiary of the Ancon levy. So I can be blamed for that, but I thought it had a purpose then. The second thing is that when we did the Ancon levy, it was not an open-ended discussion. There was a 10-year horizon, which we now extended to 13 years, at which point the levy will end and all the liabilities will be paid off. As it stands today, there is no foreseeable end to the levy. And it has become the second largest item of expense, I think, after operating expense, after the personnel cost for most banks. And it's going to keep increasing. As the assets increase, this Ancon levy will increase. And it's going to become basically unsustainable after a period of time. So there must be a plan to how to end this Ancon levy. The third thing, which occurred to me this morning, because those things worry me all the time, why do banks pay deposit insurance on money that has been sterilized at the CBN as CRR and DCRR, discretionary cash reserve ratio? If the cash reserve ratio has been sterilized and it's in CBN, then there's no reason to insure it. And so, at a minimum, all discretionary and normal CRR that at CBN should not be subject to the calculation of the deposit insurance. These are questions we should ask ourselves. And because I believe BDAN is the only forum for banks together to advocate for these things, I think banks should take BDAN much more seriously. If we agree, and I'm sure all reasonable people will agree, that there's no basis whatsoever for paying deposit insurance on money that's sterilized in the CBN, I think all of us will agree on that. If we agree on that, that's a savings of close to 50 billion a year for the banks. So I'm telling the banks, when you go back to your banks, tell them, this is a good forum for banks. This is a forum where we can fearlessly discuss these issues. And I'm sure Mr. Bode Augusto will tell us a lot more than this when he gives us his address. So please, this must not be taken as fidelity. This must not be taken as me. I'm talking as what's best for the system. And we should all ask those questions. The answers may be, well, Mr. Chike, you're wrong. There's a basis for this. That's fine, but we should have that discussion. And we should not be afraid to have that discussion. And BDAN is the best place to start those kind of discussions. And we will engage them after this and ask them and write to them and ask them to tell us why, for example, we should pay insurance on money that's at CBN. I would love to know the answer to that. But we should all take this more seriously. We should attend. I expect next year that we'll have much better attendance. And I wish us all a wonderful deliberation, and again, thanks for coming.
Thank you, Mr. President. Thank you so very much. Yes, your job. You just do a jump. Yes. Yeah, you've done 7 steps for the day, so that's 1,000 minus 7. So you still have about 993 steps for the day. Yes. All right. Fantastic. Yes, we have a few of our guests following us online. If you could flash that for me. I know we have Mr. Bello Hassan, who is the MD, CEO, Deposit Insurance. Yes, it's there. We also have Deputy Governor Aisha Ahmed. If you can see me, I'm waving at you. So good to have you join us online. Yes, welcome. We're looking forward to having a fantastic conversation today on this forum. And I haven't listened to the president. He has just started the conversation, and he has begun the question asking. He did say that one of the threats to the banks are the regulators. And luckily, we have a regulator, and I will be talking to us right about now. Yes, we have, Aisha Ahmed, Deputy Governor, Financial System Stability Directorate of the Central Bank of Nigeria. Can we put our hands together as she gives us our keynote speech?
Very, very distinguished members of the audience, honorable bank directors, distinguished ladies and gentlemen, I'm very pleased to join you this afternoon. Let me thank my brother and the chairman of the Governing Council of BIDAN, Mr. Mustafa Chikiobi, for inviting me and his team, of course, and commend the work you're doing in the areas of research, advocacy, capacity building, etc., and this important conversation. I think it's important to say very, very early on that the role of regulators is really to protect the depositors. And there's a bigger objective beyond just, of course, the financial stability is important, because if we need a sustainable system, the banks themselves have to make money, they have to be protected, but we must always keep at the back of our minds the impact on depositors and the greater good. I do not think regulators are the biggest threat for banks. I think regulators are key partners with the financial system to achieve our broader objectives. I'm sorry I wasn't able to join you physically, but I thought it was important to still make an appearance because of the importance of this platform. And I couldn't agree more with Mr. Mustafa Chikiobi around taking this association more seriously as a means for collaboration and engagement of regulators. And the fact that preserving financial system stability will be very critical in your role as board directors. I have 10 minutes, and I'll try to, in these 10 minutes, provide a regulatory or a policymaker's perspective of how we see the risk to financial stability shaping up and how we can work together to mitigate this risk and preserve stability. Just by way of the context, and I'm sure everyone is quite knowledgeable about this, we're holding this summit today against the backdrop of a significant turmoil in the international monetary and financial system. I think IMF's current 2022 annual report puts it well. It's titled Crisis Upon Crisis. And I think they couldn't be more clear about the challenges facing the global economy. We've seen them revise growth forecast, I think 3 times this year. And the projection is that 2022 growth will be 3.2%, down from 6.1% last year. We've barely recovered from the COVID-19 pandemic and its own disruptive consequences. Now we are facing what I call a confluence of new shocks. So the Russia-Ukraine war and what that is doing to food, commodity, and energy prices, the fact that there's unprecedented global inflation, and the reaction of both advanced economies and emerging markets to trying to tame this inflation is a key headwind for the financial sector. We're seeing tightening financial conditions as well for emerging markets. So even the CBN, for instance, is not left out of this tightening stance. I think we've raised our policy rate by cumulative 400 basis points this year. Clearly, the impact on emerging markets is to further exacerbate our challenges around the fiscal space, which is pretty tight, and we're also experiencing inflation and fragile growth. So this means costly loans, foreign portfolio investors exiting, currency pressure, and just a weaker domestic policy output. So we're facing a very unprecedented level of uncertainty as policymakers, and we're facing a lot of trade-offs around managing price stability, achieving financial stability, and stimulating growth as well. This is the context in which we're working with. And the financial markets and the financial system are actually in the eye of this perfect storm. Because as the dollar strengthens, we've seen globally that, liquidity is challenged in asset markets. Asset prices are crashing. Stock markets and bond yields are rising. And as policy rates rise, I think one of the biggest risks for the financial system is that, the higher lending rates that we have may threaten obligors' ability to repay their loans. It may slow down domestic growth activity, and it may cause, asset quality to be challenged. So financial stability risks have risen and is significant. I think the NPL conversation is an important one because we have thus far been able to steadily reduce NPLs. Right now, it's under the regulatory maximum of 5%. But there's a key challenge if we are not able to properly and proactively manage the loan book to ensure that NPLs do not crystallize in response. It's also important that we look at banks' net open positions in terms of the impact of currency devaluation for balance sheets that are threatened in that respect. From the CBN side, what we've done is to step up macroprudential. We're looking a lot around our surveillance. We're looking at early warning systems. We're looking at our dynamic stress testing. We're also doing a lot of scenario planning to identify vulnerabilities. Right now, thus far, we've seen capital adequacy remain strong, relatively strong, even though we have stressed in very multiple scenarios in terms of rising interest rates at the same time, currency volatility at the same time, macro. So whilst, financial stability risks have risen due to all of the factors that I've mentioned, we're also keeping our eye on the existing policy challenges that we had going into the pandemic and coming into this particular situation with Russia-Ukraine. So things around cybersecurity, issues around fraud, AML, CFT issues, data privacy, issues around the proliferation of new entrants and many unregulated entities into the financial system all remain paramount. I think as bank directors, your role in, first of all, your responsibility to shareholders, your accountability to all stakeholders, your responsibility to promote corporate governance will be important in your partnership with the CBN. And I thought it was good to end with a number of areas that we can work on together. These are our regulatory priorities that we can work on together to ensure that the system remains resilient. I think the first one is issues around single obligor limits and increasing our FX risk exposure and oversight around insider loans. I do not need to further enumerate on this. They're very open and they speak for themselves. On managing credit risk, I think we need to be proactive about reviewing the portfolio for credits that may be challenged due to increasing interest rates. I think we all remember that the CBN's regulatory forbearance to banks during COVID, allowing them to restructure loans over COVID, actually helped stabilize the system. And it's something that we can look at today as well. We need to strengthen financial sustainability. So you can see that I also admit, or I also accept, and properly even, should I say, go further to say that I advocate for financial sustainability, because it's only profit that can absorb losses, and it is only profit that can help beef up capital and further investment in the kinds of technology we need today for cyber resilience, for fraud prevention and other investments. Enhancing anti-money laundering processes is important, particularly in the HNI and politically exposed person segment. We saw that that was one of the weak links in the recent FATF mutual evaluation exercise for the country. The CBN on its own part is trying to strengthen regulations in this respect. We recently gazetted new regulations in this area. Shadow banking and unregulated entities, like I mentioned before, I think it's a key issue. CBN is working with FSRCC, other regulators, to see how we can identify and sanction these entities. But I think bank, and particularly the directors, can actually take KYC, know your customer, and know your customer's business process more seriously, in order to help us, identify these institutions. Everybody knows that the financial system, particularly the banking system, is the strategic platform with which all flows run. But a lot of these entities are actually challenging financial system integrity and people's trust in the system. Enhancing corporate governance. We've seen recently a move by banks to set up new companies within holdco structures. These companies are meant to look at payments, they're meant to look at SME financing. And whilst we appreciate the ultimate objective, I think it's very important, and from the CBN perspective, we think it's very important that corporate governance within those structures is very high. We need bank directors to remember their fiduciary responsibility and ensure that proper oversight is provided within these structures. On our side, we are doing some regulatory reform where we are focusing more on activity-based supervision, and also looking more at the interconnection between institutions within the same holdco. Finally, I'll talk about market conduct. Because we have more digital financial services, we're seeing more fraud on e-channels. Of course, on a relative basis, fraud hasn't increased, but the kind of fraud happening on those channels is significant. We've seen issues around misuse of customer data and unfair business practices. For CBN, it's very important that customers are treated fairly, and what we're doing is to integrate the market conduct risk within the existing risk-based supervision framework, so that going forward, the risk rating would actually reflect market conduct considerations. I think we should remember lastly that Nigerian banks were relatively resilient over COVID because of the reforms that happened post the global financial crisis. These reforms improved capital requirements, improved liquidity requirements, and improved corporate governance. Today, as policymakers, as bank directors, I think our own job is to be resolute around ensuring that we leave behind a system that is also strategically positioned to handle the next crisis. And I'm very confident that platforms like this and further engagements we will have will be critical to working together to come up with the strategies we need to implement and the policies we need to implement that makes banks sustainable, but more importantly, ensures that we have a safe and stable and resilient financial system. Thank you very much for listening, and I thank you for the opportunity as well to speak to you. Thank you.
Thank you. Thank you so very much, Mrs. Ahmed. Mrs. Ahmed, Yes, I got that right. Thank you so very much, Mrs. Aisha Ahmed, Deputy Governor, Financial System Stability Directorate, CBN. We appreciate your keynote speech. My takeaway here, she's calling for more collaborations with the banks. Regulators need to collaborate more, or the banks need to collaborate more with the regulators. That goes directly to the president, Mr. Mustafa Chikeobi. And then, well, we've had the bank speak, we've had the regulators speak. Just maybe we'll get a balancing right now when we call on Mr. Olabode Augusto to give us a keynote speech. Just maybe we can get a balance in here going forward. He is the managing director, Augusto and Co. Can we put our hands together for Mr. Olabode? Thank you. Founding managing director. Sir.
Thank you. The regulators, bank directors, Mr. President, ladies and gentlemen, good afternoon. And I thank you very much for inviting me here today to come and speak to you. And I thank the President for the kind words that he's spoken about us. And he came up here and said that the regulators are a threat to the banking sector, or maybe those were not his words actually. But then I see two principal threats. The first one, I agree with him, the regulators. The second one, an even bigger threat, is the federal government of Nigeria, the size of their debt. And I'm going to talk about that, digressing from my paper a little bit, because as people were speaking, I realized that that's an important factor, but I have sort of focused on the banking sector. So I'll start with a little bit of history, that in the early 1990s, Nigeria decided that our banking industry should be owned by the private sector. Accordingly, the government sold our equity stake in the banking sector. Most notably, First Bank, Union Bank, UBA, the three biggest banks that had about 70% market share as at then. The era when bank directors, including the CEOs, were appointed by government on 9 o'clock news ended with those privatizations. Well, because those of us who are old enough, we remember the old days when they would announce the board of banks on 9 o'clock news. To ensure safety and soundness of the banking sector, the government set up the NDIC to ensure bank deposit. Government also constituted a committee consisting of regulators and private sector practitioners to prepare the prudential guidelines to be used in valuing the banking sector's loans to its customers. And that was the time I met MK Ahmad for the first time. He was a director at the NDIC. So I remember those times very vividly. After the implementation of the prudential guidelines, the three biggest banks, First, Union, UBA, incurred huge losses that eroded all their capital. But they were still able to meet their obligations in a timely manner. What then happened? That was the first time I had a provision. The regulators issued a circular allowing them to defer the losses for a period not exceeding 4 years and amortize the losses over 4 years. But good thing, in less than 4 years, all of them returned to profitability and rebuilt equity and covered the losses. Since then, the CBN and the NDIC have worked together to ensure that the banking sector is safe and sound. The global financial crisis of 2008 also had a significant adverse effect on the banking sector. In 2009, the banking sector incurred losses of 6.2 billion US. I had to translate it to US dollars to make it more meaningful, but it was 900 and something odd billion naira, or 3% of the GDP, 3.8% of the GDP of Nigeria. It wiped up 2/3 of equity. A number of banks, commercial and merchant, failed. As part of the distress resolution, Ancon was set up in 2010. to buy the industry's problem loans, replacing the toxic assets with FGN guaranteed securities. To fund the distress resolution, banks were obliged to initially pay 0.3% of total assets. Now I believe it's been increased to 0.5% of total assets and contingents. Period of 10 years. The president said it's been extended for 3 years, but the law that I looked at says it's been extended for 5 years. So I don't know who is right. We now have 3 principal agencies to help ensure safe and sound banking sector. The CBN to set the rules and regulations and to monitor the health of banks, the NDIC to ensure deposits, and Ancon to buy problem loans. A safe and sound banking sector is the responsibility of the board of directors of banks, as well as the regulators of banks. The CEO of one of the key banks in Nigeria once said, and I quote, "The most important regulation in the banking industry is self-regulation," unquote. This means that the board of directors of banks must take wise and prudent measures to safeguard the assets of these institutions. Are there new perspectives that bank directors and regulators should note? Certainly, and we believe that they should start from the quality of the banking industry's assets. In today's world, a bank requires a robust internal credit rating system. Your internal credit rating system must be as strong, if not stronger, than those of external ratings, because lending is your business. A bank must assign a rating to every significant loan it gives, monitor the validity of the ratings, and seek explanations for any significant difference between their internal ratings and those of external rating agencies. An astute board will go further and ensure that those responsible for managing the day-to-day running of their bank price for risk. How do we know whether or not our bank is pricing for risk? Say, let's do a simple exercise. Let's put all our large loans in the rating bucket that they belong in. And let's use the interest income we earn from that rating bucket to calculate the yield. And if we are pricing for risk, when we start from a AAA rating and we start to go down, the yield should increase because the risk is increasing. If the yield is not increasing, that means we're not pricing for risk. Information technology also now allows banks to gather and analyze significant information about the habits of their customers. Banks are therefore in a position where they can use data analytics to better select risks and manage their portfolio of advances to retail customers. IFRS 9 enjoys reporting entities to take a forward-looking approach to calculating provisions for financial instruments, including loans to customers. This is because the bulk of a bank's loans to its customers are to businesses and households, and the macroeconomic environment has a significant impact on the ability of these customers to repay their loans. Macroeconomic outlook is one of the base components of IFRS 9's expected loss model. The most common factors used by banks to forecast macro outlook are exchange rate, inflation rate, unemployment, GDP growth, oil price, and oil production. We recommend that apart from these key prices in the economy, indicators that measure the impact of the economy on small businesses and households should be used for retail loans. Banks should therefore consider using real wages. Are real wages rising or falling? That's going to have a significant impact on the ability of your retail customers to repay their loans. Real GDP per person, average income per person, is it rising or falling? The misery index, inflation plus unemployment. Banks should also review every key industry that they lend to and determine those that are pro-cyclical, counter-cyclical, or non-cyclical, because this will enable them to better assess the impact of the macroeconomy on these industries and the businesses therein. The regulators must allow banks to freely evaluate borrowers and select risks that are within their risk appetite. This is a critical role that the banking sector plays in every economy, and it must be allowed to do so freely. Government can, of course, have sectors that they want the banking industry to lend to. If these sectors do not meet the banking sector's risk acceptance criteria, government must find ways to de-risk these sectors to ensure that they meet the hurdle rate set by the banking sector. This could include guarantees, partial or full, and or interest rate subsidies borne by the government. The current practice under which banks are forced to lend money to the so-called preferred sectors at subsidized rates robs banks of precious profits that can be used to strengthen their capital buffers. Banks require capital to absorb losses. The first line of defense for absorbing losses is of course the current year's profit and loss account. However, when the losses exceed current year's profits, they erode shareholders' equity. We have seen complex capital adequacy rules come out of Basel in Switzerland. However, we must leave bank directors with a simple rule that will help you ensure that your banks comply with these complex rules. Our own recommendation is that you should just take a simple rule. For every 100 naira of assets that you have as a bank, you should have 12 naira 50 kobo of capital. So your equity to capital ratio, equity to assets ratio should be just around about 12%. We believe that with this level of capital, a bank will meet all the stringent capital adequacy rules. So let's move to more interesting areas now. Internally generated profits represent the principal source of capital to a bank. Any bank, your internally generated profits. Okay? Nigeria is a high inflation environment with a long-term rate of inflation of 12%. Because if you take the 10-year average inflation for Nigeria, you're going to get 12%. If you take a 15-year average, you get 12%. You take a 20-year average, you get the same 12%. So, this means that nominal assets of the banking sector will grow rapidly. Therefore, to maintain that relationship of 12% your equity capital to assets ratio, it means that your profits must also grow. How much profit should a bank in Nigeria make? The principle for calculating the expected return on equity is simple. You start with your risk-free rate and you add your equity risk premium. What then is the risk-free rate for Nigeria? One can use the 10-year yield on the Naira bonds, which I think today is maybe 12-13% or thereabouts. But we prefer to use 15%. How did we arrive at 15%? We said that we take the long-term rate of inflation plus 300 basis points, 15%. Professor Damodran of NYU Stern School of Business estimates that the equity risk premium for Nigeria is around 10%. So if we add 10 to that 15, we get 25% return. But how did Professor Damodran arrive at this 10%? What he has simply done is to take a benchmark country, the United States of America. What is the equity risk premium for the US? It's about 5-6%. So here now adds a country risk premium. What's the difference in yield between Nigeria's 10-year bond and the US's 10-year bond? So that yield has spiked significantly because of the flight to safety, but it's typically around 5% as well. So 5 plus 5 was what gave him 10. So we expect to earn a return of 25% return on equity. Today, how many banks in Nigeria are delivering 25% return on equity? None. At least if we look at the half-year results. Earlier, we prescribed a 12% capital to assets ratio. If we turn this ratio around, I'm sorry, I'm going to do a little bit of simple arithmetic. It's not even math. If we say 12.5 over 100 is the relationship we want between capital and assets. If we turn it upside down, we get our assets of 100 divided by 12.5 of capital. The number that we get is 8 times 8x. It becomes a leverage ratio. So if we take our return on assets and we multiply it by 8 times, we get our return on equity. So we worked backwards and say that if you look at banking sectors run across sub-Saharan Africa, the leverage is typically between 6 to 8 times. So we take the high number of 8 and say let's divide 25% by 8 times. It means that the after-tax return on assets must be a little bit above 3%, around about 3.1% is the return on assets that you must deliver. Okay? So this means that we should deliver return on assets of about 3.1%. And if we assume a tax rate, because I want to do some comparative analysis, if we assume a tax rate of 32% for Nigeria, because that's our tax rate, plus the levy of 2.5%, and we take my 3.1% and we divide it by 1 minus the tax rate to get what my profit before tax should be. What number do I get? I get 4.7 as the expected return on assets for banks in Nigeria. Today, what are we delivering? We're delivering 1.7%. That's what we're delivering. Why are we not able to deliver the 4.6%? Why? The answer is what I describe as negative regulation. That is the bottom line. That's the answer. And I'll explain why. Okay? First of all, 0.5% of total assets and contingents will go to Ancon levy, isn't it? We take 1.7, we add 0.5 to it. It's actually 0.6 because it's total assets and contingents. We get 2.2, isn't it? Okay. So we also say that 50% of our total assets, 50% of our total assets, then 50% of our Naira deposits, I beg your pardon, they're in CRR. Although the legal number is 32.5%, but effectively it's 50%. We have worked it out. It represents roughly 25% of total assets, 20-25% of total assets. So if 20-25% of my total assets are under lock and key, earning nothing, let's now look back. What typically is a normal level of cash reserves? 10% be the normal level. Okay? So if we want to reduce cash reserves to 10%, that means that we need to release 40%. 40% on our total assets. When we relate it to total assets, if we say it's 25% of total assets, 40% of 25%, for those who know math, 4 times, that's 10, okay? So we're releasing 10% of total assets. That's what we're releasing. If we assume that we invested those at, let's even say, the long-term rate of inflation of 12%, what do we get? We get another, we're releasing 10%, isn't it? 1.2. So we're adding 1.2 to that, isn't it? We're at 2.2. We add 1.2 to it, we're at 3.4, isn't it? Then the last bit that we're going to take is that the risk-free rate is rigged, more or less, isn't it? It's significantly below inflation. If we had a situation whereby the risk-free rates were raised to, let's say, the long-term rate of inflation, 12%, 1 year yield on government securities, maybe 13% is what we have. We're going to reprice our loans. We're going to reprice what we're going to earn more on our earning assets. And that will add the difference to us. And we get to that 4.6 very easily. So our estimate is that these 3 aspects of regulation will be eroding roughly 3% of the return on assets of the banking industry. 3% of 60 trillion is 1.8 trillion. What is the current profit before tax of the banking industry? 900 billion. So we can triple our profits. We can pay more taxes to government as well. So that is a principal issue. It is therefore urgent and important to have our regulators rethink and help the banking industry enhance its capacity to generate capital from internally generated profits. the key reforms that we believe should happen should include allowing the risk-free rate measured by the average yield on 1-year government securities to be at least 100 basis points above long-term inflation. We're not saying chase the short term. At least let people who are saving, people who are managing pension assets over a long period of time be able to earn positive returns. Because if the current situation continues for some considerable future period, we're going to erode the purchasing power of our pension assets, and we're going to start screaming that the defined contribution system doesn't work, not admitting that they were the ones who have killed it. Reducing cash reserve requirements to not more than 15% of deposits, or at least, these are the people who can negotiate this. The EDs of banks cannot negotiate it, or pay pay interest on the excess cash reserves. Pay interest, because today the cash reserves are being used to finance advances to the federal government of Nigeria. And the last time I checked, we're charging the federal government of Nigeria 200 basis points below MPR. So let them give us 400 basis points below MPR, and they can take 200 basis points spread. Ancon levy should have a defined lifespan. If you say it's 5 years, or 3 years, let us carve it in stone. And we know that we have put that behind us. So let me also digress a little bit now and talk a little bit about the federal government of Nigeria, that I also say is a big risk. And the way I define that is that Nigeria is on the road to Zimbabwe. Somebody needs to stop us. And I'm dead serious about this. We are on the road to Zimbabwe. How does a country get to Zimbabwe? Our politicians will start by spending more than they earn. Okay? And the gap gets wider and wider. How do they fund this? They start borrowing from the domestic financial system. The interest in the domestic financial system will spike up. They say, okay, Nigeria is an oil producer. I will go outside and borrow money. Okay? Go outside and borrow money. You leverage yourself in foreign currency as well. Today, we are not over-leveraged in foreign currency, but certain things have happened that has made it more difficult for us to borrow in foreign currency. One is that oil and gas revenues have come down significantly. The second thing is that there is war in Ukraine, and is a flight to safety. It is, energy prices have gone up, world inflation has gone up, US interest rates are rising. Therefore, people would rather take their money and invest in US securities. So the emerging market bond yields have gone up 12-13% for 10 years for Nigeria today. The government will not borrow at 12-13% when they used to borrow at 6-7%. So that door is now shut. We are now borrowing from the central bank. Okay? So we have a central bank that will support the government by lending money to them via overdraft. But today, what is the aggregate debt of the federal government of Nigeria in Naira terms? In Naira terms, we have about 42 trillion. What is the revenue of the federal government of Nigeria? True revenue, it's maybe at best about 4.5 trillion. So what we have is that the relationship between the debt and the revenue is roughly 10x. In all our analysis, we have never seen 10x anywhere before. The median for countries in sub-Saharan Africa is 2x. Ghana, that has gone to see the IMF, is below 3x. Sri Lanka is 7.7x. So if we say we are not over-leveraged, we are just deceiving ourselves. So those local currency debts, unfortunately, nobody forgives local currency debts. Who are the holders of these local currency debts? The banks, the insurance companies, the pension funds, and everything. Are you going to tell them to take a haircut? So we need to do something about that. And that's a big, big challenge to anybody who takes over and says they want to run the government of Nigeria in May. It's a big, big challenge. How do we get out of this? So, let's try and conclude after that direction. Say we cannot conclude this paper without talking about the competitive landscape as well. Fintech companies, mobile operators have entered the banking industry. They are grabbing share of the transaction money of the banking sector. Transaction money represents one of the principal sources of the banking sector's profitability, because people who want to settle their transactions don't worry too much about interest rates. They are concerned about three principal things: how efficiently you can settle their transaction, the cost of settling the transactions, and the safety of their money. So the new entrants have promised to settle their transactions efficiently, and they've told them that they don't need to come to the bank. You can use your mobile device to settle your transactions. They don't charge fees, and they are presenting themselves as safe. Traditional banks, people describe them as unreliable and expensive as they charge for their services. This means that the new entrants, they have differentiated themselves in a manner that is valuable to their customers. So when we talk about differentiation in strategy, the important thing is that you must differentiate yourself in a manner that is valuable to the customers. This actually reminds us of a little bit over 30 years ago, when you could only transact business in your branch, isn't it? The then new generation banks, including Zenith, GT, Chartered Bank, they promised their customers that they could transact business in any of their branches in Nigeria, and they delivered on that promise. What then happened? They differentiated themselves in a manner that was valuable to their customers. I remember very clearly that one of the big banks today was trying to market Nigeria breweries, and then their balance sheet was smaller than the balance sheet of some of these big companies, so they ignored them. But after a few months, maybe 6 months down the road, they realized that my sales collection all over Nigeria would be more efficient if I could access the money that people were lodging all over the federation, and it didn't take them long to open an account with that bank, and things began to grow. So those banks began to gain market share. So before the old generation banks could move, this story we're all aware of it. Anyway, they built sizable market share. They boosted profitability, and they were able to invest in a bigger branch network. So a clear example of a situation where they differentiated themselves in a manner that was valuable to their customers. Are these new entrants going to change the structure of the banking sector in Nigeria significantly? They certainly can use technology to customize, to scale and customize their services. Nigeria has a young population that will embrace them. They are not burdened by the cost of brick and mortar. But the big question that I have about them is that do they have the discipline to manage a large-scale business? The jury is out. Thank you very much.
I really think Mr. Bode deserves a better round of applause. If you wouldn't mind, sir, I think we would appreciate if we could have a grip of this presentation, whichever way you can do it, because this is very in-depth, and I'm sure that it does answer quite a number of questions. Yes, so, thank you, sir. All right, he sure does answer a few questions, and I'm sure the ball is already rolling, really rolling. He did bring some form of balance in the conversation, but then he says we are still looking for X, 10X. We've been looking for X ever since I was in the university, secondary school, and I hope we find X. But then it is indeed a very sad situation that we find ourselves in terms of our debt profile as a country, which I think we should take a lot more seriously. Oh, fantastic. Should I come to you? You want to come to me? Okay, I'll come to you, sir. Yes.
No, I just wanted to say thank you again. And we never discussed this presentation. So his thoughts are his and mine are mine. But just to clarify what I meant by threat, I didn't mean threat in the sense that they are maliciously affecting the industry. I meant threat in the sense that their actions will determine in a disproportionate way what happens to the banking industry. And so you need always to anticipate what the regulators are doing. So if my word seemed inappropriate, it's what I mean to say is that they are an outsized influence in the banking industry, and we have to be aware of what they're doing and what they're saying. Thank you.
Fantastic. Thank you, Mr. President, for that clarity. All right, so we're taking the conversation a little bit deeper now as we'll run into the panel session. Let's deepen the conversation. Trust me, I wouldn't like to be on this hot seat. And luckily, I'm not going to be on the seat. So, but then our elegant Mrs. Sonara Duke will be on the seat. She'll be the moderator for this panel session. Just to remind you, we're looking at the conversation around safeguarding financial stability in Nigeria, the new perspective for banks, directors, and the regulators. So I'll do her the honors, which of course it's a bit out of place, but I'll do her the honors. And naturally would have invited her while she calls her panelists, but she did ask me to invite all. So I'll invite everyone right now. So I'll start with you, Mr. Nariju. Could you please take the podium? Can we put our hands together for her? Thank you so very much. Thank you so very much. Just to also let you know, we'll be having another regulator, but this time virtually, from the NDIC. Can we make welcome Mr. Bello Hassan, who is the Managing Director of the Deposit Insurance Corporation, the Nigeria Deposit Insurance Corporation. If we have him virtually, let's establish that. Okay, we don't have, well, it's there, but it's muted. Can we unmute Mr. Bello Hassan? Can we unmute Mr. Bello Hassan? Can we? Okay. Hello, MD, if you're there. Hello. Good afternoon.
Yes.
Oh, fantastic.
Good afternoon.
Can we see your picture? Can we see your video as well? It's important.
Yes, that's what I'm playing. Yes. Can you see me? Good afternoon.
Oh, fantastic. Yes, good to see you
Thank
there
you very much.
again. Yes.
Thank you for having me.
Yes, yep. And then let me also invite Mr. Ayodele Othihinwa, who is the partner and head, Financial Services Industry, KPMG, Nigeria. So good to have you join us on the podium, sir. Please, a round of applause for him. Forgive us, this is our set. We'll manage better next time. Please do sit on the other side. And finally, let me invite Mr. Aminu Ismail, Executive Director of Finance and Operations, Ancon. Yes, they are here today. Okay, you want to jump like the president? Yes, it's very agile. All right, so at this point in time, I would leave this panelist to you, Mrs. Anori. Please do justice. Thank you.
Thank you very much. Mr. President, special guest of honor, keynote speaker, distinguished ladies and gentlemen, I hope that we're all set at this time for an interesting session as we go into the panel discussions. This year's bidden topic, we all agree by now, if there was any doubt, which I don't think there was, that it's both urgent and very relevant. And this session has been designed, focused primarily, to ensure the conversation goes in the direction of having both the regulators and the banks, ensuring that they are both keeping to their own end of the bargain towards ensuring that our financial institutions are not at stake. And so, having listened to the remarks, very deep remarks by the special guest of honor, the Deputy Governor of CBN, as well as the presentation we have just listened to by Mr. Augusto, we now have our panelists ready to lead us into the deep discussion. I know that the Managing Director of NDIC is joining us virtually, and so we want to say thank you for being able to join the panel discussion, Mr. Hassan. And so, ladies and gentlemen, the panelists have already been introduced to the House, and we will proceed with the few questions we have, in the next 20 minutes for our panelists. And I'd say the first will go to you, Mr. Ayodele Otiwa, on the issue concerning what you would say concerning the role of the regulators in safeguarding the financial health of our country.
Good afternoon, everybody. It's a pleasure to be here, to be a part of the panelists to talk about the banking system stability. I'd like to first of all thank Mr. Bode Augusto for dissecting the banking sector very well. And would also like to acknowledge the Deputy Governor. Truth is that the banking sector thrives on trust. If there's no trust in the system, financial services cannot function very well. And to promote the element of trust requires vigilance and cooperation. Vigilance on the part of regulators, cooperation on the part of owners of banks and managers of banks. We all have a stake in ensuring bank stability. Now, when Bode was talking, he spoke about provisioning IFRS and a lot of things. I am also an auditor. And as an auditor, we go to banks to examine the books of banks. And I can tell you that not all banks are actually very thorough in the determination of their impairment amounts. Typically, in most of the audits that you find and the delays you see, is an argument between the auditors and the bank management in the amount of impairment that should be made by the banks. Even between the regulators and the banks, it's also the same problem. Therefore, one thing that is clear is that we need ourselves to ensure banking stability. You cannot leave it on to the banks alone. The truth is that the banks, everybody wants to make profit. An impairment is a number that reduces the amount of profit that you make. Therefore, when you see the economic situation suggesting that these loans are likely to be bad, instead of you to be prudent and take a forward-looking perspective, like you said, and make adequate provision, the first thing is for you to say to yourself that, I don't think this is going to crystallize. Or even if it's going to crystallize, I have it under proper management. Therefore, I do not want to take the impairment. So the regulators are there to ensure that you take the impairment. The auditors are there to ensure that, okay, they are able to have a compromise amongst the regulators, the bank management, to ensure that at least adequate provisioning is made for loans. Also, before I stop, corporate governance is key. So corporate governance on the part of the banks to ensure that they are properly managing their risk. They have systems.
In just a minute, if you can just share with us if, in your experience, you think the compliance level of banks to the regulators is adequate.
That's a difficult question. Very difficult because when you say adequate, what do you mean? Because there's a whole set of rules that you need to comply with. Sometimes the rules are onerous, and no single bank can comply with all of them at once. So I would say the compliance level is moderate for now.
Thank you.
Yes.
And Mr. Ismail, thank you. I was wondering what the objectives of Ancon were at the time of its establishment, and how far would you say the agency has gone to meeting this objective for which they were created? In other words, has the agency been successful?
Good afternoon, everyone. Good afternoon, moderator. And Bidan, thank you very much for inviting us over to have a word in this conversation. For us, financial stability obviously is paramount. You might say it's a self-fulfilling prophecy for us, but the more stable the institutions are, the more you don't need us. And our success derives from you not needing us, at all. In terms of the objective for the creation of Ancon, if we cast our minds back to the earlier financial crisis of 08-09 and how it turned up, locally here in the economy, and what it left in terms of the stress that was evident from the different tests that were conducted by the central bank. The CBN determined that there was significant stress in the system and there was systemic risk, and there was a need to have this intervention. And that is how Ancon was created, with the sole objective of stabilizing the system, at that crisis point. Ancon did Ancon's intervention was through two intervention modes. The first being, which is the most visible, that everybody sees, but interestingly is the smaller portion of the two, which is the purchase of bad debts, which is the eligible bank assets. In our act, they're called eligible bank assets from banking institutions. So we purchased those bits, onboarded them. Initially, we paid for them in kind through bonds, which were eventually paid for in cash through funding from central bank. So to the extent that we bought out all of those debts out of the system and provided liquidity to the system, that was very successful in doing. The second part of what we did was the financial accommodation bit, which was providing funding to the banks that were either in below minimum capital regulatory requirements, or in most instances had even gone into negative territory. So we provided funding to bring them back to minimum capitalization levels, and in the process rescued 8 of the institutions, which was the R8, and eventually breached 3 out of those 8 institutions. Now, the extent of success of these two issues, or these two interventions, is that, one, there was no failure across the industry as a whole. If we remember, the extent of distress was quite significant, and there is no way that those institutions would have survived. A lot of the institutions, we've had the benefit of seeing them from the inside, beyond what a lot of people would have seen, or particularly would have been obvious, or have been in the public space. But certainly there was no way those institutions would have survived, and the extent of systemic risk would have been quite, significant for our system. So we have hindsight now. We can complain about the charge, but for that time that it was an absolute necessity, and it's been quite successful, and it's a very successful intervention.
Great. Thank you. And to that extent, how much bad loans have been disposed by Ancon, and how much is left to be disposed?
The numbers, we had there were 2 purchases in 2011 and in 2013. And between those 2, we bought out 12,743 accounts out of the system. 12,743, that's a magic number for us. Now, to give a bit of a profile, which would now give a bit of context when I talk about what has been resolved, out of the 12,743 that we bought for purchase consideration of 1.7 trillion, 350 of the 12,743 were 1.2 trillion. So I'll say that again. 350 out of 12,743, which is 70% of the entire portfolio, was 1.2 trillion. So the rest of the 12,000 blah, 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 were just simply 30%. That's the extent of the kind of concentration that we had. What is remaining? To date, we've resolved slightly under 6,000 of those accounts. And slightly under 5,000, slightly over 5,000 of those accounts. And we still have 7,000 plus. 6,500 of which is under our asset management program. So those are the ones that, we're dealing with through our selected third parties, and so on. So that gives a profile. 45%, to a large extent have been resolved. But why I gave a profile of the portfolio is to tell you that it is not in the numbers, but in those large, loans that we've been able to deal with.
Thank you very much. So while I go on to Bello Hassan to join us virtually on his questions, I just want to encourage, the House to put together their questions, because we want fresh ideas, new perspectives on how the two participants, the regulators and the bank, would deepen and stimulate their relationship into ensuring, that in these disruptive times, that the undesirable outcomes are not experienced by the financial industry. So, Mr. Bello, I would want to ask in NDIC, as a regulator, we know, and it has been discussed already, both by the President had mentioned it and the keynote speaker also did, that the banks currently remit a percentage of their total assets and deposit to both Ancon and NDIC. Does this not put too much pressure, and financial restraint on the banks? What's your take on that?
Thank you very much. Good afternoon. Can you hear me?
Yes, we can.
Okay, good afternoon once again. Please permit me to stand on the well-established protocols. And my apologies for not being there in person. It was actually due to the exigencies of the office. And honestly, I'm delighted and honored to be invited as a panelist at this year's Bank Directors Annual Summit with the theme Safeguarding Financial Stability in Nigeria, New Perspective for Bank Directors and Regulators. Before I answer your question, if you allow me to just give a little background before I answer the question. Because I see a little, maybe there is need for me to clarify some things around deposit insurance. Deposit insurance, let's understand it, as we all know, is a system normally established by government to protect depositors against the loss of their insured deposits, which they place with member institutions, in the event that those institutions are unable to meet their obligations to depositors. So in general, the system is supposed to engender confidence in the banking system, thereby promoting financial stability, and also is supposed to provide a definite means of depositor reimbursement in the event of failure without recourse to treasury. Even though in the opening remarks, somebody mentioned that in the last couple of years, CBN has been paying. But is that what we expect to continue to happen? So overall, deposit insurance is supposed to promote confidence in the overall financial system, so also to outside investors. And it also provides a mechanism for addressing bank failure. As we speak, there are 92 jurisdictions around the world that practice deposit insurance, and it is widely recognized as one of the safety nets within the financial system. So in Nigeria, our deposit insurance system is based on what we call ex-ante funding. And what does it mean? It means it's an arrangement where the deposit insurer collects premiums with the aim of accumulating the funds to meet future obligations, that is reimbursing depositors, and of course to cover part of the operational and related costs of the deposit insurer. You see, we forget about what is happening in Nigeria. There are what we call core principles for effective deposit insurance system issued by IADI, that's International Association of Deposit Insurance. Those core principles are used to determine how effective a deposit insurance system is within any jurisdiction. And if you take, for instance, core principle 9 of those standards, it talks about funding. And that core principle says the deposit insurer should have a readily available funds and funding mechanism necessary to ensure prompt reimbursement of depositors' claim. And more importantly, the responsibility of paying the cost of deposit insurance should be borne by banks. I'm not talking about Nigeria. This is what the standard says, best practice. Responsibility for paying the cost of deposit insurance should be borne by banks. That's what that standard says. And like I said, 92 jurisdictions are practicing deposit insurance system like we have in Nigeria. And that is what is obtained in all those jurisdictions. So Nigeria is not an exception. And let me mention, when NDIC started, the premium was charged based on flat rate. When we started, it was 15 over 16 or 1%. That's about 95 basis points for the deposit money banks, and for other institutions, it's 8 over 16 or 1%, which is about 50 basis points. But along the line, in 2008, NDIC transited from flat rate to differential premium assessment, whereby the premium to be charged any bank is a function of its risk. Underline this one very well. The premium to be paid by any bank is a function of its risk. And the rate was reduced from 94 basis points to, there were two components of the rate. There's the fixed rate and there's the variable rate. The fixed rate is 35 basis points, and then the variable rate is 30 basis points. Even though when it started, the initial sum was 50%, but later it was reduced. So for the sake of time, let me just mention that now for banks, the base rate is 35 basis points, while the add-ons are 30 basis points. So in total, the premium that is being charged bank is 60 basis points. That is the max. 65 basis points. That is the maximum. So what I want to challenge directors that are here, when they go back, they should ask their management, how many basis points do they pay in terms of deposit insurance premium? Because that will give them an idea whether they are managing risk properly or not. Because let me make this disclosure. The bank that has the highest deposit in Nigeria doesn't pay the highest premium. So this should be a food for thought to directors. When they go back, they should ask their management, how many basis points are we paying? And like I said at the beginning, you need to pay deposit premium so that you accumulate funds, so that in the event of failure, we can utilize that fund to pay. Yes, in the last couple of years, deposit money banks, none was liquidated to pay. But as late as 2020, CBN withdrew the license of 35 microfinance banks, and they are in liquidation, and it's NDIC that is paying them. So let us understand this. It's not a charge that is done arbitrarily. There's a basis for that, and it's based on defined standards. And like I said, in about 92 jurisdictions, that is what they practice. So we are just trying to copy what is best practice. Thank you very much.
Thank you very much. I know this, we're ready for a few comments from the House, but before I leave it open, I want to just add that With regards to the electronic money institutions, what safeguards, and I'm throwing this open to the panelists and to the House as we take on the floor, what are the safeguards that we have in place, for depositors? Because we certainly must also consider the safeguards against, all the deception, all the espionage, and all the sabotage of various facets that are in the space. So that's part of the conversation that we would want to, look into. And just to throw it back again at Ancon, if Ancon is set for a specific period, what would be your take on what should happen when the sinking fund ends and the financial institutions or the banks have a problem? How do you think it will go on from there after the tenure of Ancon perhaps comes to an end? And is there any such in the near future?
Thank you. I think first and foremost, I do remember that in Mr. Augusto's presentation, he did talk about, the three layers of dealing with stability that we have, which, you had the regulator, you had self-regulation, and of course you had Ancon. What it means is once Ancon goes away, there's a greater responsibility on the part of, first of all, the industry. And when I say the industry, it goes back to to this association and the members of the association for greater supervisory roles over their institutions. Ancon is and should be an intervention agency, meaning that it was set up for a particular purpose. It dealt with the loans coming from that period. And once it deals with that issue, like we've seen in most other jurisdictions around the world that have used this model of banking crisis resolution, then really it should go into its sunset. Because the truth is the moral hazard is real, and we've seen it. There would be the requirement for stricter control of the institutions, first of all by the board of directors. Now, I would also make reference to what has happened in other jurisdictions that we have seen. Nobody has done this twice, to the best of our knowledge till today. Most people that have tried the bad bank model never went back to it. And the reasons and the arguments, are probably discussion for another day. It depends on what side of the divide, you look at it. And I would take the people that started all of this, which was the Americans, and they started it with the Resolution Trust Company, which was the first bad bank in the world in the 1980s after the mortgage crisis in the US. Now, RTC dealt with, those issues. And when the second crisis happened in the 1990s in the US, the regulators or the system allowed some of the institutions to fail. And it became a self-regulatory mechanism to a larger extent. I think the thought of always having an Ancon to bail you out is in itself a problem. And the institutions and the industry should be able to manage the risks that are created, by the industry, by itself. So, that really is my perspective on it.
Thank you.
Let me just add a perspective to it. If you look at Ancon today, I would just like to ask some questions. At the point when Ancon was set up, how did Ancon finance the monies it gave to the banks? How much is Ancon owing? And then how much has been realized from the assets that you have? Now, from the little knowledge I have, I know that the funding or the charges to the banks today are being used to defray the bonds that was issued by Ancon to pay off Ancon. Now that amount, from what I heard, is about 4 trillion. And you just said now that the total asset you have is 1.2 trillion. So that's a gap of how much? 2.3 trillion. So if you wind up Ancon today, who pays that money? Taxpayers? Or who? So again, so for me, when I think about it, there's a lot of things to be balanced before you come to a determination of sunset. And then after that, I agree that Ancon should be strictly focused on the objective for which it was set up. Resolve that. And then going forward, we need to proactively think about a resolution system for the banking sector should another systemic crisis happen. When you allow banks to fail, you allow banks to fail when it's just one bank or one or two banks who is not so interconnected in the banking system. Then that way you can allow a bank to fail. But where you have 8 banks, 10 banks, all having problems at the same time, and then you allow them to fail, you will create a social upheaval. People will start committing suicide because there will be a number of people who have their monies in deposit money banks who will suddenly realize that they don't have money again. And the next thing you will have is a lot of suicide. And these same people who are complaining will be the one asking government to intervene with taxpayers' money. So there's a lot of balancing game that is required to do this, which is why I don't agree that the Ancon charge is reducing profitability. For me, it's the price they have to pay for the stability in 2008 that we had, because if that had not happened in 2008, the social consequences of it will be significant. I think the only other point we need to ask regulators really is, if you have CRR that is actually in a place that is very safe, the risk of that money getting lost does not exist. Why do we pay NDIC premium on that? I think that is one that we need to address. Thank you.
For that input. And yes, thank you, Bello Hassan. We would hear your perspective on this issue. Thank you.
Thank you very much. You see, on this issue of Ancon contribution, this is my personal opinion. How did this obligation arose in the first place? It was not created by government. It was not created by central bank, neither or NDIC. It was created by the banks. And it was done in the interest of maintaining financial system stability, and which everybody is enjoying. So what I want urge us to always think is to look at the big picture. Not that, okay, this is affecting my profitability. It's affecting my profitability. Look at the big picture. If the system is unstable, you won't be talking about profitability. So, and if this thing was created by the banks, certainly the government should not be the one, because you cannot socialize your losses and then personalize your profits. I think that's something we should not encourage. The bank should continue to bear that in the interest of financial system stability, because that was the basis for all doing that. You see, like I mentioned, a CRR, premium on CRR, we are not getting the point. In any insurance system, somebody has to pay premium. How do you determine that premium to be paid? And I've already mentioned, as we speak, there are banks that pay 65 basis points, and there are banks that pay only 35 basis points. And that's the challenge for directors that are here today. Go back, ask your bank, your management, why are we paying 65 when we can actually pay 35? If we manage our risk very well. I think that's what banks should focus, because there is no way we can say don't pay premium at all. Otherwise, we cannot build that fund to enable us use it if there's any failure in the future. And I think going forward, the CBN, NDIC, they have other resolution tools available at their disposal to use without necessarily resorting to Ancon. We have done purchase and assumption, we have done merger, we have done bridge bank, we have done open bank assistance. So there are so many. So each case will be treated based on its merits when it arises. I'm not sure we want to continue going to Ancon. I think that one, we better allow Ancon to wind up those obligations, and then we continue normal life. Thank you very much.
Thank you very much. I must allow the, some comments and questions from, members, and then you just have.
Yes, I think the figures.
Yes.
Yeah.
Okay, you want.
Sorry, just to clarify, since I'm the chief culprit of Ancon, and I was at the start, the levy was not the bank's idea. It was the CBN that suggested the resolution required 30 basis points of total assets. When I came in and we did the modeling, we realized that 30 basis points would not be sufficient. So we had a meeting with the banks at a co-hotel, and the banks agreed voluntarily to go to 50 basis points. Now, so let me give you some inside story. When the CBN governor, Sanusi, was about to depart, he called me and said, it's very, very important we make this into a law. Because at some point in the future, when I'm not around and you're not around, the banks will start complaining about this levy. So it was passed into law. It's a law. So it's not the bank's idea, it was CBN's idea, banks went along with it, and now it's a law. That's the truth of the Ancon levy. Now, just to clarify, this is not, again, from my point of view, anything about insurance. I think deposit insurance is best practice. I agree with deposit insurance. That's not the issue at all for us. The issue for us is if CBN is keeping half of our deposits, why should there be an insurance on 50% of our deposits that are in CBN? If insurance must be paid, then let CBN pay the insurance on the money they're holding. Because we're not holding it. It's sitting there in CBN. We can't access it. We get close to 0% on it. So if insurance must be paid, then maybe CBN should pay the insurance because they're the ones with the money. Or we can say that these deposits are safe. They no longer have to be called deposits. They are in CBN, and they should not attract, that portion should not attract a premium. The portion that we're using, absolutely, we'll pay premium on it. We'll pay the premium on it happily. But the second deeper question is, if in the last 4 or 5 interventions or failures, Ancon has been the one to pay. In other words, Ancon has paid, the banks are obligated to pay Ancon. Why are the banks then paying insurance premium to NDIC when they are going to pay to Ancon by paying Ancon levy? It's a double whammy, and it has to be addressed. And this is not anything against the principle of deposit insurance. This is not anything against NDIC. It's just the fact that if banks continue to pay those 2 levies, it will get to the point, it's easy to calculate, where banks would no longer be profitable. And the thing we're afraid of the most will happen. Banks will start failing again.
Thank you very much, Mr. President. Yes, we have another hand. Thank you.
Thank you. Good afternoon.
If we could have your name, please.
My name is Ancon Adewale. It's not so much a question as an observation. To me, I think one of the most unfortunate things that's happening right now is how scared banks are of the central bank. And I don't think it's healthy for the central bank or the system that you have banks that are so scared of the central bank. And when something appears to be arbitrary, nobody has the guts to ask. So I'd actually have loved to see Deputy Governor Ahmad on the panels. So maybe she can talk to us. Because I'll give an example. Commercial paper, for instance, is not supposed to be subject to CRR. Then you have a situation where all of a sudden a bank's CPs are put under CRR and nobody can question it. You know, people are too scared to question the central bank. And I think that's probably what portends the gravest danger, that things can be done and people will say we can't ask them. Or maybe there's one-on-one, negotiations, there's no even playing field. That's very dangerous for the system. And to speak to why maybe BDAN wasn't being taken seriously before, I never got the impression that BDAN was taking up this role of advocacy and lobbying. And I'm extremely excited to see that that's happening now. Thank you.
Thank you very much. We get into the focus of the of the session, which is to really explore how do we stimulate and deepen the collaboration between the regulators and the banks. So we're hearing more of that, and I'm sure BDAN will forge these conversations further and stronger with the regulators to ensure that this session and all of these conversations we are having is not going to end in this room, but the conversations must surely continue. Did you want to?
Can I respond?
I'm not seeing any hand except his.
Can I respond?
Yes, please.
Okay, thank you very much. I think this is what I've been trying to explain since I started.
Sorry.
To say that based on best practice, one of the core principles requires that deposit insurer should have funds readily available in order to meet reimbursement to depositors' claim on depositors' claim. It is not a question of this money is with central bank, so you cannot lose it. No, but if the money is with CBN, doesn't mean that the bank cannot fail. So this is a deposit insurance system, and you need to pay premium. I thought banks should be praising NDIC for adopting differentiated premium assessment, where the premium is a function of risk profile rather than flat rate. Whether you are doing well or you are doing badly in terms of managing your risk, you are charged the same rate. No, we differentiated it based on your risk. I thought banks should embrace that and be present that no, this is best because it's equitable. And let me say this: the fact that banks are contributing to Ancon, it doesn't mean that banks should not pay premium. Banks are contributing to the sinking fund to enable Ancon meet obligations already incurred. While the premium we are collecting, we are building fund against the future. Are you saying, I'm not praying for it, if banks are to fail now, are you saying that it is still central bank that will come and dole out money to pay those depositors? I think the existing arrangement that we have in place should be allowed to take its course, because that is why we are building the fund. So that if anything happens, unless you are saying that we don't need to build fund, let's wait until it happens, then we decide what to do. I don't know. I don't know whether I can talk briefly on this issue of CRR. Even though, I don't know whether you permit me to talk on that.
Yes, why not? Go on, please.
Okay.
Thank you.
You see, but with a caveat, I'm not a member of the Monetary Policy Committee, and neither do I speak for them. But what I want to, and the message I want to pass to banks is that one of the mandates of CBN is to ensure monetary and price stability. Because let us understand it, macroeconomic conditions influence the effectiveness of markets. The ability of the financial system to intermediate resources and economic growth is dependent on how stable the macroeconomic condition is. Persistent instability hampers the function of the markets, and such conditions affect the ability of financial institutions to absorb or manage their risk. And no doubt in periods of economic instability, market volatility can lead to destabilizing depositor runs, which we are trying to avoid. Because no bank can withstand a run, no matter how strong it is. No bank can withstand depositor run, no matter how strong it is. So CBN, there is no way CBN can ensure price stability without controlling, having ability to control liquidity within the system. And the bank has various tools to use to manage liquidity. One of them is CRR. like I said, it's important that for us to look at the big picture. What they are doing, I believe, is in the interest of the stability of the system in general, not particular bank. Because I believe for a bank, it's better you declare a profit of 1 million under a stable micro environment than to declare a profit of 10 million under an unstable environment. This is just my personal perspective, please. Sorry. I just said I should mention that. Thank you very much.
Thank you. Thank you. After,
We still have some questions.
please.
Yes,
go
I
on,
wanted
Mr.
to
So we just
I
take
wanted to
maybe
quickly
one-
respond to
three
the
more
issues that he
questions.
raised earlier.
All right.
And the figures that were quoted were just a portion. Don't forget, I said it represented what the big borrowers. The entire portfolio of bad debts is 1.7 trillion. But there is also the portion on financial accommodation, which is another 2.2 trillion added to that. So just taking it as 1.4 and asking for that difference. Secondly, it would have to be part of the agreed, wind down process for Amcon on how to deal with any excesses or any surpluses. And if you look at the last amendment that was done in the Act, that was even touched upon on how the liquidator of Amcon is going to deal with either excesses or shortages on the final sunset of Amcon itself. And the second issue had to be with ensuring financial system stability and providing another level of a net for depositors. And I mean, I put that back again to this gathering, that financial system stability and regulating the system is between the banks and the regulator itself. And the system must get to a point where it is self-regulating. The presumption that there would always be an institution that would come and bail out systemic risk is not sustainable. And we will continue to go back to this same point that we are today to say, for how long can we continue to contribute, without trying to be an advocate of, the industry. Or, sometimes when you see, because all of the debts we bought from all of the banks, but two banks did not sell any bad debts at all. But they still are contributors to the sinking fund for the greater good. Now, the question is, do we continue to sustain that kind of system where people's behavior is disproportionate, but then the whole industry has to bear the burden for only God knows how long? I don't think it is a sustainable system. And self-regulation is certainly more important, than proposing this system. Thank you.
Thank you very much.
Can we take more questions?
Maybe,
Some
yeah.
hands are still up.
Okay. Okay, all right. Thank you very much.
I just want to throw a bit more light on this issue of CRR and the size of government overdraft. Because the Central Bank Act actually says that yes, the central bank can lend money to the federal government of Nigeria on what they describe as ways and means borrowing. But there's a limit there. The limit is 10% of previous years, 5%, okay? 5% of previous year's revenue, okay? And we're bankers in here. The rationale for that is because government revenues can be lumpy in nature. Therefore, we allow them this temporary overdraft. It's TOD, which they should clean up at the end of the year. And if they don't clean it up, don't lend anything additional to them. So the situation we have now is that the size of the overdraft is like 40 times. Sorry, I'd like to use 40x. The legal limit. And we're saying that we use cash reserve to control money supply. We're taking it with one hand and putting it back into the system with another hand. So it's not impacting money supply and interest rates either. So that's the point I just like to make, because it's way over the legal limit.
Thank you. Thank you very much, Mr. Gessi.
One more question.
Thank you. And yes, so
just not sure who to direct this question at, but I guess it's maybe some of the bank directors here. You did mention about the the CRR debits. And I'm just curious, what would be your response to the disparity between the savings deposit rates and the lending rates? Because on one hand, banks are upset that the CBN is sequestering trillions of naira in deposits as CRR. But then, on the flip side, depositors also complain that, look, we're getting less than 3%. I think it's just recently increased to 4% in savings deposit rates. Whereas on the flip side, the money is being lent at maybe 18, 20%. And of course, inflation rate, we all know, is 20.5% already. So you have that disparity. It would be interesting to know what your views are. And secondly, the CBN governor did mention that one of the reasons why they had increased CRR was to curtail money supply. So money supply is at its all-time high. I'm sure we all know that. We've never seen this sort of money in the system before. I think lending to the net domestic credit is probably about 60 trillion or thereabouts. So, and from the look of things, bank credit to the private sector is about 27 trillion. So are we running ahead? Are banks heating up the economy, or is this all part of driving economic growth? Because this is probably what the CBN governor is alluding to. It'd be nice to just hear from banks. And then finally to you, sir, on Ancon. How come we don't see Ancon accounts published? I remember in the days of Oga Chikobi, we used to see their results on their website. I mean, but these days, you don't see Ancon results, you don't see CBN results. Is there something that we're hiding? Just be interesting to know. Thank you.
Thank you, thank you. Was that the last question? I don't see any other hand up in the room. So on that note, I'd just ask you to give us your closing remarks, maybe 1-2 minutes each. Whose question? His question. His question. Yes, I was hoping he would take it as part of. No, the one on Ancon.
No, the one on savings should be answered by Bode. The disparity between lending rate and saving rates. So, Bode, let's have your view.
You answer for us. Thank you.
Look, banks are economic animals. So if I take a deposit and I pay 5% interest on the deposit, and CBN takes half of it, that means I'm effectively paying 10% for the deposit, because I can only use half of it, so you multiply the rate by 10%. Then there's a liquidity requirement from the CBN, 30%. By the time I add that 1 naira that I got as deposit, in the end, I can only lend maybe 30 kobo out of it. That 30 kobo, I'm paying 5% on the whole thing, so that gives me, and I have to then pay my other costs and everything. So when you raise your CRR, you do two things. You raise the lending rate, you lower the deposit rate, and you increase the probability of NPLs. It's a self-defeating tactic. It works in the short term. In the long term, it's self-defeating, because banks will adjust their interest rates to make profit based on what the CRR is.
The consequence is NPLs. All right. Thank you very much.
Okay, the second part of the question was publishing our accounts, and I would say to you, sir, that it is a statutory requirement which we comply with every single year. So it is published in 2 or 3 national dailies every year, and consistently we have
they'll upload it maybe on their website now.
No, it is.
It's nice to have.
Self-regulation. Okay. Yes, please. Thank you. Thank you, ladies and gentlemen. The people on the audience live. If we have questions, do we have any? No. Any questions from our online participants? Thank you. Not yet, anyway. So, I mean, this conversation. There's a chat box.
Do we have chats?
I can't read. Who is going to read it for me? No.
Okay, it's from the host.
They're saying none.
He said no chats.
I say no. It's okay. All right. Then, yes, thank you. You can wrap up for us
Okay.
then.
Okay,
2 minutes.
Okay, I think to wrap up, what I would say is that we are focused so much on traditional banking institutions. But as Bode mentioned, we have a new set of new banks, digital banks, payment system banks that are becoming significant in this economy. They are becoming significant, but the regulation of this sector is very limited. And these guys are young and reckless. Reckless in the sense that not all of them have the experience to manage institutions of that size. They don't have footprints. You only see them on your mobile phones. And the day your money gets lost, you'll be searching for them on your mobile phones. So it's important that we begin to think about regulating them. Now, if you look at the way banks are going now, almost all banks are going the holdco model. So the traditional banks are separate, then they create a digital bank within that same structure. So obviously there's a regulatory arbitrage that they are taking advantage of in terms of regulation. Therefore, regulators must wake up. Because again, these new banks, they have not been faced with crisis any day because they are new. So we don't know whether they have experience or not. And we don't need to wait for that. We need to be proactive and design a system that can ensure that we will know on time that they are about to fail. Today, there are a number of these digital banks where their CEOs and EDs will just wake up and leave the country. And then they will just jackpot. And then they are sitting on huge amount of customers' deposit that nobody knows what to do.
Over $1 trillion in the last
So
10 years.
that is an area I think we need to think about. Thank you very much. They are digital banks.
No,
Digital banks.
To the extent that they are
Digital banks
they're
still deposit because what they do, they get a banking license, and they get a banking license under microfinance banks. So all of them, if you go and look at most digital banks that are not hyped out of traditional banks, they have a microfinance bank license which allows them to take deposits. And then, of course, they scale, like everybody said, they scale very largely. Risk is very high. And if you see most of them, if you go and even look at it very deeply, crypto transactions are done by these entities, which is a high-risk business, and nobody is regulating them. Nobody even understands what they do. So it's important that we begin to think deep about the system and ensure that we have the right safeguards to serve as a deterrent. Thank you.
Thank you very much.
Okay. What I would want to just say in closing is to say that, was that me? Okay, thank goodness. That there will always be periods of boom and bust, biblical times, for as long as the world exists. And the important thing for banks is to be prepared, for these cycles. In 2008, 2009, one can argue that three things happened here: the devaluation in the currency, the sharp drop in oil prices, and the crash of the capital market. Now that translated into significant distress. In the last year, we've seen a sharp devaluation of the currency. Thank goodness the capital market and oil prices, thanks to Ukraine, is still holding out. But in what form or manner it will come is the question. But it will come. And when it comes, it is important that banks are prepared for it. And the way banks have to be prepared is risk management. I mean, I guess because we have seen the quality of assets that have ended up in Ancon and the profile of, the lending, there is a lot of work that still needs to be done in the area of risk management in the banks. And it is important that the directors are able to focus on these systems. Ancon is a living example, to tell you how not to do the business of lending, because we see it on a portfolio basis. Of our portfolio, 1/3 of our portfolio is oil and gas that came to us. Now, it begs the question, it defines what the portfolios of the banks are, that level of concentration. Have the banks learned any lessons from that? Or did they just take the liquidity that was provided by the system, by Ancon, and forgot about, you know, how to improve their risk systems and what to do so that it does not happen again? You see the same trends, you know, happening all over again. What are the lessons that we've learned? The premiums are quite painful, as I can imagine, to profitability levels. But what are we doing to make sure that the quality of risk assets in the system is consistently maintained at a very high level? Not because the regulator says it is 5%, but it is because it is an existential threat. If we do not do it, and we don't keep the levels way below that, sooner or later, we're going to run into the same kind of instability and volatilities that we've had in the systems. Thank you very much for listening.
Thank you very, very much, to everyone for this session. And one last final comment from Bello. Thank you.
Yeah, thank you very much. I think I like this type of conversation. And but let me say that this creates for a formidable relationship between banks and regulators. I think is to understand each other's expectations and strive to achieve it. From a supervisory or regulatory perspective, regulators or supervisors expect banks to exercise high professionalism in their risk-taking activities. They expect full compliance with extant regulations and guidelines. Regulators expect information from banks, and banks are expected to provide prompt and accurate responses. In addition, they also want early communication from banks on issues or areas of emerging risk, because as operators, emerging risk may be identified by them more quickly. And recognizing risk early can help in developing appropriate response mechanism that will maintain a safe and sound banking system. From the supervisory perspective, we know bankers want opportunity to provide input in the formulation of regulatory policy, which I think it has been happening. A number of guidelines, circulars that were issued, they first of all come out as exposure drafts, where input from banks are harvested and incorporated before it is finally released. So they are carried along. I believe conversation like this is very good. I want to see regulators as enablers, not a threat to the system. If we cast our mind back to the 1950s when there were no regulation, we know what happened that time. And I believe that era is gone for good. Nobody is looking for a repeat of that. So regulators and operators must collaborate, because the whole objective, I think, is for us, we want to have a safe, sound financial system so that businesses can flourish, and then there will be growth and development within the economy. Thank you very much for having me.
Thank you. Thank you very, very much. And one point that's continuing to be reiterated in this session is that we do need to continue with ensuring a very robust internal, control systems, rules and regulations to ensure that investments and assets are protected. And these conversations certainly would have to continue, because to safeguard our nation, to safeguard the financial system, and to ensure jobs, creation, as well as economic growth for our country, and even the level of insecurity we're all facing. We cannot afford to have a situation where the financial institutions are faced with, further challenge that they are. So I know that BIDAN will continue these conversations. No doubt the regulators are in-house. The key regulators have all, agreed that these conversations will continue, and we look forward to, next year's BIDAN annual meeting when we'll look back on the outcome of today's meeting. Thank you very much, and God bless you. Thank you.
Fantastic conversation. The show must go on. Gentlemen, thank you very much. Before you leave the stage, can I invite the president, members of council, and our keynote speakers to a joint photograph before they leave? Can we all come to the table for a joint photograph? Oh, yes, before then. We can do the photograph before they come down. Yes. Yes, former president, Mrs. Authority Demerin. Please join the photograph. Thank you. Thank you.
What I have to do is actually the simplest part of the program. I'm glad I wasn't part of the panel because I think they did try to address some very pertinent questions, very, very tough questions. Thank you so much. So, first of all, let me appreciate the Deputy Governor, Mrs. Aisha Ahmad, for gracing the occasion as a special guest. I think she actually set the tone for the conversation this afternoon. We also appreciate Mr. Bode Augusto. Thank you. We knew you had to shift a couple of things in your calendar to be able to accommodate this afternoon. Thank you so much for the key points that you raised for us. And to our panelists, we do appreciate you. Mr. Bello Hassan, he joined us virtually, the NDIC MD. Interestingly, he used to be the Director of Banking Supervision, so you can understand when he was trying to explain the CRR situation. Mr. Aminu Ismail, thank you. He was meant to travel, but no, God has a way of making things happen. So it was good that you are here with us this afternoon. Mr. Ayodele Othiwa, a long-time friend and colleague, so thank you for being here as well. And obviously to Her Excellency, Mrs. Honore Duke, for moderating the session. But perhaps, I think the most important players today are actually chairmen of banks, the directors of banks, the managing directors of banks that found time to be able to come for the summit. We do not take this for granted. We look forward to more active participation from bank directors. When we set out to have this summit this year, what we told ourselves was that there was a need for BIDAN to take its place when it comes to discussions around how the industry is being managed and regulated. And we said we needed to come up with a kind of topic that would stimulate conversation, raise very tough questions, and ensure that we take key points away. For us, I think we've achieved that. This is just the beginning. We didn't set out to get all the answers today, no, but to give a platform for everybody to realize that there's a need for us to have conversation, both as regulators and as players. And obviously, bank directors play a key role in that. Some key takeaways from me, I think the president in his opening speech threw the first dart, and when he said regulators are threats, I think he didn't mean it that the regulators themselves are the threat, but perhaps actions of the regulators could pose some threat. And I think he was looking at the SWOT analysis and putting it in that bucket. But there are always two sides to a coin. you know, something that could be a threat could actually be an enabler. And I think that's what the Deputy Governor and the NDIC MD did help us to understand, that really it is not the intention for the regulators to be threat, but they enable, particularly enable financial stability. And I think they continue to do that. But we're all players in that. The keynote speaker, he did talk about negative regulation. This is the first time I'm hearing that kind of phrase. Perhaps it's something for us to, as BDAN, you know, to research into and see how best we can turn negative to positivity. There's a comment from Mrs. Adewale, which I think is quite important for us to reflect on. When she said, in a situation where banks are unable to challenge or to question the actions of the regulators, it could portend some kind of danger to the industry, that it is not healthy. I think the main thing is that we're all players. And to that extent, the regulator should provide an enabling platform to engage, you know, so that new ideas can come forth. I think overall, for me, this is just the beginning, like I said. But before I close, just to remind us that BDAN as an association has 3 key focal points the current council is focusing on. The first one is advocacy, and I dare say part of it is what we're doing now, and subsequent actions following this. The second one is capacity building. There's a need to continuously build capacity within the industry when it comes to governance, when it comes to the director's responsibility. I think it's very important. And as directors of banks, I will appreciate if we can take this more seriously, and BDAN will come up with a lot of programs to engage directors and build that capacity. The third one is research and development. You know, this is an association that can provide some elements of analysis and research that will provide opportunities to generate new ideas and actions. And this will be beneficial not just to the banks, but also to the regulators. Overall, let me say thank you to everyone here present physically and those that joined us virtually. We look forward to your participation at the next summit. Thank you. Have a safe trip back home.
Thank you. That's it. We're done. Mr. Dayo thought his job was easy, but it wasn't as easy as he thought it was. We have stirred the waters, so whoever needs healing should go to the river and get his healing right now. The water has been stirred. So have a great day and let the conversation continue away from here. Have a great journey back home. Bye for now.